So think about this for a second. Tomorrow morning, like over $70 billion of everyday people's money is just going to aggressively rush toward a single company all at the exact same time.
Yeah, it really is just a staggering mobilization of capital.
I mean, $70 billion, that is enough cash to buy Ford, Delta Airlines, and Domino's Pizza outright.
Yeah.
Like you could just hand over the money and you own all three of those massive companies.
Right, but instead all of that capital is just chasing one single stock.
Exactly. And welcome to the deep dive, because today is Thursday, June 11th, 2026, and tomorrow is the day the entire financial world has basically been holding its breath for.
Oh, absolutely. Elon Musk's SpaceX is finally making its historic public debut under the ticker SPCX.
And we've got this massive stack of financial articles, market analyses, and insider reports sitting right in front of us. Our mission today is to just cut through the absolute deafening noise surrounding this.
Because the noise truly is deafening right now. It is incredibly easy to get swept up in the whole cultural moment and, totally lose sight of the actual market mechanics at play here.
Yeah, we're going to examine this massive $1.8 trillion valuation target. And we'll break down exactly what this mega deal means for broader markets, for index funds, and most importantly, for your own portfolio.
Which is what really matters at the end of the day.
Right. But, I mean, the cultural moment is inescapable. This IPO has completely breached the zeitgeist.
It really has.
I was looking through the brokerage data in our sources, and it's surrounded by these just hilarious anecdotes about how retail investors are acting right now.
Oh, the stories are wild.
Like, there are internet jokes flying around about the, quote, SpaceX lunch lady getting wildly rich post-IPO.
Right.
And people are sharing memes about the stock being aggressively marketed at grocery stores. But my personal favorite from the articles, I actually laughed out loud at this one.
Oh, which one?
There's an ex-user who posted that their mother-in-law's Mahjong club is going, quote, all in on the SpaceX IPO.
Wow. The Mahjong club.
Yeah. Exactly. When the local Mahjong clubs are mobilizing their retirement funds, things have escalated way beyond just a normal Wall Street event.
Yeah, the anecdotes are definitely humorous. But, beneath all the memes, there is a very serious financial narrative unfolding here.
For sure.
The sheer numbers we are looking at in these reports are historic. I mean, the IPO was initially targeting a $75 billion raise.
Which is already huge.
Right, but it has met with quadruple that interest. That $70 billion you mentioned earlier.
Yeah.
That is just from retail orders alone.
Wait, really? Just retail?
Just retail. That means regular, everyday people, not the massive institutional hedge funds, are trying to force $70 billion through a very narrow door all at once.
Wow. Okay, let's unpack this. Because that level of retail frenzy, it just doesn't happen in a vacuum.
No, it doesn't.
That cash has to come from somewhere.
Yep.
Right? Which means if you've been looking at your portfolio this June and wondering why your incredibly reliable chip stocks are suddenly bleeding red, well, this is why.
Exactly. You are feeling the gravitational pull of SpaceX before it even goes public.
Right now, retail investors are so desperate to get in on SpaceX, they are literally actively liquidating their other holdings just to raise the cash.
Yeah, the sources highlight a very specific capital rotation happening right now.
Right, like a massive shift.
Investors are aggressively selling out of major tech shares and semiconductor stocks.
Which is crazy because those have been so strong.
They have. They are abandoning historically strong, reliable sectors specifically to build a war chest for Friday's SPCX listing.
It makes me think of the market as like a closed-loop water system,
Okay, I like that.
There is only so much liquid cash flowing through the retail market at any given time.
Right.
So if you suddenly want to fill a massive trillion-dollar bucket labeled SpaceX, you literally have to drain the tech and semiconductor buckets to do it. The water has to come from somewhere.
That's a great way to visualize it, like a massive cruise ship dropping anchor in a really small harbor.
Oh, exactly. It violently displaces the water and rocks all the other little boats around it.
It inevitably does.
But this sort of market indigestion, this massive reallocation of cash, it makes me wonder if the market can actually handle it. Especially because our sources explicitly note that SpaceX isn't the only giant looming on the horizon right now.
No, it's definitely not. We are actually entering an era of what analysts are calling hyperscalers.
Right. And just to clarify for anyone listening who isn't, a Silicon Valley insider, a hyperscaler is basically a company operating at such an unimaginably massive global scale that their infrastructure demands are astronomical, usually in cloud computing or AI.
That's right. And both OpenAI and Anthropic have recently lodged SEC filings indicating that their own trillion-dollar listings are coming soon.
Oh, wow. So it's a whole wave.
Exactly. So this current feeling of market indigestion isn't just about SpaceX, it's the anticipation of a whole new class of mega IPOs.
That sounds kind of terrifying for the broader market.
Well, what's fascinating here is that if we connect this to the bigger picture, we might actually be looking at the relationship between IPOs and market health completely backward.
Wait, how so? Because reading through the financial press right now, I mean, the narrative feels incredibly panic-driven.
It does.
The headline essentially reads, like, the market just can't handle another hyperscaler without taking a massive hit.
Yeah, it feels intuitive to think a giant IPO drains the market. But let's look at the economic concept of causality here.
Okay, walk us through it.
Companies, especially at this colossal scale, do not typically issue an IPO to test a weak or fragile market.
Oh, right, that makes sense. They wouldn't risk it.
Exactly. They issue stock because equity demand is already incredibly strong. They move forward when earnings momentum is healthy and when investor risk appetite is highly elevated.
So they wait for the perfect weather, basically.
Right. The issuance of this much stock doesn't cause the broader markets to fall. Rather, a strong, vibrant market is exactly what invites the issuance in the first place.
I see.
The causality runs from the strong market to the IPO, not the other way around.
So it's not that SpaceX is going to break the market. It's that SpaceX is basically taking advantage of a market that is fundamentally robust enough to actually absorb a $1.8 trillion debut.
Exactly. If the foundational economics weren't there to support it, the investment banks underwriting this deal would never price it at these levels. They know the liquidity exists to support it.
That makes a lot of sense for the active traders. You know, the people physically logging into their accounts, selling their NVIDIA or AMD stock, and queuing up to buy SpaceX. But here's the thing. SpaceX is so unimaginably big that even if you don't actively buy it, it's going to end up in your 401k anyway.
Oh, absolutely. It's unavoidable.
And that is forcing the people who run passive index funds into a very difficult corner, which is creating a massive structural shift behind the scenes.
We are talking about the fast pass phenomenon.
Right. So if you manage a massive index fund, there are usually strict rules about how long a newly public company has to prove itself before you add it to the index.
Standard procedure.
But the sources detail how major index providers, specifically NASDAQ, LSEG's FTSE Russell, and the CRSP market indexes, have basically completely moved the goalposts.
They really have.
They've adjusted their inclusion rules to make it possible to add new, massive companies like SpaceX to their benchmark products much, much more quickly than they traditionally would.
And that rapid acceleration into the index has turned into a veritable political lightning rod.
Oh, it really has. It's a huge controversy. Senator Elizabeth Warren is actually petitioning the Securities and Exchange Commission to actively delay this IPO.
Right.
And just to be totally clear to you listening, regardless of where anyone falls in the political spectrum, we are not taking sides here. We're not endorsing or rejecting Senator Warren's viewpoints at all.
Exactly. We are strictly looking at the economic mechanics behind her argument. We're just conveying the contents of the source material from a purely financial perspective.
Right. And she warned the SEC that the net result of this fast pass could be, quote, disastrous for everyday investors.
So if we look at the mechanics of this impartially, the concern is deeply grounded in the way index funds fundamentally operate.
Okay, how does that work?
If you fast-track a mega IPO into big benchmark indexes, you create a massive, unavoidable ripple effect of forced buying.
Let's actually walk through what forced buying means for the person listening.
Sure.
Say I passively invest my retirement money into a broad market fund that just tracks the NASDAQ composite, right? When a massive company like SpaceX gets fast-tracked into that index, the manager of my fund can't just sit on the sidelines and wait to see how the stock performs, right?
No, they absolutely cannot.
Their fund's rules dictate they literally must buy SpaceX stock just to keep the fund matching the new makeup of the index, regardless of what the price is.
That is the exact mechanism. If the index says SpaceX represents 2% of the market, every passive fund tracking that index is structurally obligated to ensure their portfolio is 2% SpaceX. They have no choice but to buy.
Which, I mean, that has to artificially pump the stock price, doesn't it?
Yeah. It does. It creates an intense surge in demand that isn't driven by people actually analyzing the company's value. It's driven simply by mathematical obligation.
So they're just buying blind, basically.
Exactly. So the fear detailed in the sources is that while this artificial forced buying surge is happening, corporate insiders at the rocket company could take advantage.
The people who got their shares for pennies years ago.
Right. They could theoretically unload their overpriced shares onto those unwitting retail investors.
Oh, man.
Yeah, investors who are just trying to park their retirement dollars safely in a broad market fund are suddenly holding the bag at the absolute peak price.
I was actually looking for a counter-argument to that in the sources, and the articles do mention that SpaceX might not even be eligible for the S&P 500 for a year.
They call it a seasoning period.
Right. On paper, doesn't a one-year seasoning period protect those retirement investors from that initial day-one volatility and any potential insider dumping? Like, just let the active traders fight it out for a year and then put it in the index.
It sounds like a really solid safeguard.
Yeah, it seems logical.
But the analysis in our sources points out that a longer seasoning period doesn't necessarily mitigate the core concern at all.
Really? Why not?
Adding an IPO to a major index, even a massive one, is actually a mundane, routine occurrence in finance. At the end of the day, the risk to the passive investor isn't about the waiting period. It all comes down to whether the post-IPO valuation accurately reflects the true corporate value of the company.
Oh, I see.
If a stock is fundamentally overvalued, it doesn't matter if your index fund buys it on day 1 or day 365. You are still buying an overvalued asset.
Here's where it gets really interesting. Because you just used the term true corporate value.
I did.
And if you dive into the source material, trying to determine the true corporate value of SpaceX is completely tearing the financial community apart right now.
Oh, it's unprecedented.
We are looking at a valuation tug-of-war that is unlike anything in modern history.
Valuing a company that operates in completely uncharted territory fundamentally breaks traditional financial modeling.
So let's set the baseline here. SpaceX has stated they plan to sell at $135 a share.
Okay.
Now, some retail investors, like the folks in the Mahjong Club we talked about, might actually get this price through their broker allocations before the stock hits the open market.
Right.
But here's the catch. While the historical retail playbook is to basically flip hot IPOs on day one for a quick profit.
Right. The classic cash grab.
Exactly. But the sources note some brokerages are aggressively threatening penalties for quick sales on this one.
They are trying to manufacture stability.
Yeah.
If you buy the allocation and flip it the same day, your brokerage might restrict you from participating in any future IPOs. They want to punish that day one volatility.
Wow. So if you get shares, you're heavily incentivized to just hold on to them, which makes the actual underlying value of the stock absolutely paramount. It's like valuing SpaceX right now is like trying to appraise a house where one appraiser is strictly counting the bricks, looking at the plumbing, and measuring the square footage. And the other appraiser is pricing in the fact that the house might eventually become a magical portal to another dimension.
That is a remarkably apt analogy for the divide between the bearish and bullish analysts right now.
Right.
Let's look at the appraisers counting the bricks, as you say. We have academic and analytical perspectives coming in well below that $135 target.
Why below?
Aswath Damodaran, an NYU business professor famously known as the Dean of Valuation, has run the math and puts the stock at just $98.
Okay, 98.
And Morningstar analysts are even more conservative. Their models value the stock at a mere $63.
$63. I mean, that is less than half of what SpaceX is asking for. When the hype is this culturally dominant, how are professional analysts arriving at a number that low?
Because when Morningstar analysts look at this, they are using traditional discounted cash flow models.
Which, for those of us who aren't CPAs, basically means looking at the actual cash a business generates today and trying to figure out what all its future profits are worth right now in today's dollars.
Precisely. And when you run a discounted cash flow model on SpaceX, you run into very grounded, earthly realities.
Right, actual engineering constraints.
These analysts are looking at the massive, continuous capital expenditure required to scale what are essentially orbital data centers, which is what the Starlink satellite network is.
Wow, orbital data centers.
Satellites degrade. They fall out of orbit. They require constant replacement.
It's not a one-and-done expense.
Exactly. The analysts are questioning the long-term economic viability and the total addressable market for reusable rockets. They are looking at how the company currently makes money today, not how it might make money in a sci-fi future.
Right.
From a strictly traditional perspective, they argue the $135 price tag is completely divorced from current fundamentals.
But then you have the other appraisers, the
Yeah.
ones pricing in the interdimensional portal.
The bulls.
Because the bullish views in our sources are just staggering. Analysts at Oppenheimer issued a price target of $190. And then you have billionaire investor Ron Barron. His take is that SpaceX could be worth $30 trillion in the next decade.
30 trillion.
And $30 trillion.
Yeah.
He is explicitly pricing in moonshot scenarios, up to and including Elon Musk successfully colonizing Mars.
Right.
But, I mean, how do you even build a financial model for colonizing another planet?
You don't. You simply cannot put a traditional price-to-earnings multiple on the colonization of a new planet.
Yeah, that seems impossible.
A PE ratio compares a company's stock price to its actual per-share earnings to see if it's overvalued. But how do you calculate the quarterly earnings of a Martian colony in the year 2040?
Right. What are the profit margins on Martian real estate?
Exactly. It defies the standard metrics of finance, but it highlights the core tension here. Are you buying a logistics company that launches satellites, or are you buying the foundational infrastructure of a multiplanetary human civilization?
And right now, it seems like the market is aggressively betting on the latter.
They certainly are.
According to Polymarket data in the sources, bettors currently see a 45% probability that SpaceX's market cap will top $2.2 trillion by Friday's close.
Wow.
Nearly half the market believes it will instantly shatter that initial $1.8 trillion target as soon as the bell rings.
Which basically brings us back to the most critical question for you, the individual tuning into this deep dive.
Right. So what does this all mean? What does it actually mean for you, the person listening right now, thinking about your own portfolio?
Exactly.
Beyond just trying to buy direct stock, which we know is tough and heavily restricted by those brokerage rules we mentioned, the sources remind us that you can get exposure to this mega IPO through ETFs and eventually those broad index funds we talked about.
But whether that exposure is actually good for your portfolio is entirely independent of the hype, the memes, or the promise of a Martian colony.
Oh, totally.
It depends entirely on the fundamental rule of all finance, the price at which you buy and the price at which you sell.
Right.
It is just like any other investment. If you buy into a $30 trillion dream at a $1.8 trillion valuation, and the company hits a mundane engineering constraint, say, a rocket redesign that halts launches for 2 years.
Which happens in aerospace all the time.
All the time. If that happens, the math is going to punish you, regardless of the ticker symbol.
It's a brutal reality check, but an absolutely necessary one. So, to quickly recap the wild journey we've been on today.
It has been a wild one.
We've navigated the meme-fueled cultural hype of the SpaceX IPO. We've broken down the staggering $70 billion retail frenzy and exactly how that massive reallocation of capital is causing macro market indigestion and dragging down your reliable chip stocks. We explored the incredibly controversial index fund fast-track debate and the mechanics of forced buying that have made it a political lightning rod. And finally, we unpacked a valuation gap that is so vast it stretches from an earthly $63 a share all the way to a $30 trillion Martian empire.
It really is a historic moment in the markets, without question.
It truly is. And if you want to keep following this story as it develops, make sure to open the full version of our show and follow us on Spotify.
Definitely.
One click is all it takes to subscribe, and it really helps us keep delivering these insights and market updates straight to you. Also, be sure to share this deep dive with others who might be trying to make sense of the market right now. Thanks so much for your support.
And before we go, I actually want to leave you with a final thought to ponder.
Oh, go for it.
It's a question that stems directly from the mechanics we've discussed today. If mega IPOs like SpaceX and soon OpenAI and Anthropic are so unimaginably massive that they instantly alter the gravity of the entire stock market, forcing major benchmark indexes to completely rewrite their inclusion rules.
Yeah.
Are everyday investors actually making passive investment choices anymore?
Wow.
Or is the sheer overwhelming scale of these trillion-dollar hyperscalers reshaping your financial future, whether you actively choose to participate or not?
Are you choosing to step onto the playing field, or is the sheer size of the game just dragging you in? That is a huge question. Thank you so much for joining us for this deep dive. We'll see you next time.